Welcome back to the channel. In today's video, we're discussing an important topic that impacts so many financial decisions: your credit score. As a quick refresher, a credit score is a three-digit number between 300,000 and 850 that represents your creditworthiness based on data in your credit reports. Lenders use credit scores to evaluate the risk of lending to consumers, with higher scores generally indicating lower risk. That's why maintaining good credit is so important. It can save you thousands in higher interest rates over your lifetime. Absolutely, a good credit score is a financial asset that influences several aspects of your life. Let's explore why it matters. 1. Borrowing power. When you apply for a loan or a credit card, lenders use your credit score to assess the risk of lending you money. A higher credit score often means access to better interest rates and higher credit limits. Conversely, a lower score might result in higher interest rates or even denial of credit. 2. Interest rates. A better credit score translates to lower interest rates on loans and credit cards. Over time, this saves you significant money in interest payments, whether you're financing a car, purchasing a home, or using credit cards for everyday expenses. 3. Housing opportunities. Landlords often check credit scores before renting out properties. A good credit score can help secure a lease, whereas a poor score might lead to higher security deposits or even rejection. 4. Employment prospects. Some employers conduct credit checks as part of the hiring process, particularly for positions involving financial responsibilities. A higher credit score might be seen as a sign of reliability and responsibility. 5. Insurance premiums. Insurance companies often consider credit scores while determining premiums for auto or homeowners insurance. A better score might lead to lower insurance rates. 6. Utilities and services. Utility companies and service providers may check credit scores before offering services or setting payment terms. A good credit score might mean lower or no security deposits for these services. Overall, a good credit score opens doors to financial opportunities, saves money, and enhances financial stability. It's a key component of your financial health that can't be overstated. Let's discuss some of the factors that influence your credit score. Credit scores are influenced by several key factors. 1. Payment history. This is one of the most significant factors. Timely payments on credit accounts, loans, and bills contribute positively to your score. Late payments, defaults, and bankruptcies can significantly lower it. 2. Credit utilization ratio. This ratio compares the amount of credit you're using to your total available credit. Keeping this ratio low, ideally below 30%, demonstrates responsible credit management. 3. Length of credit history. A longer credit history often translates to a higher score. It shows a track record of responsible credit use over time. 4. Types of credit. Having a mix of credit types, credit cards, loans, mortgages, can positively impact your score. It shows that you can manage various forms of credit responsibly. 5. New credit and inquiries. Opening multiple new credit accounts in a short period or multiple hard inquiries can temporarily lower your score, as it might indicate financial stress or a higher lending risk. 6. Public records and collections. Records like bankruptcies, liens, or accounts in collections can significantly lower your score, as they signal financial difficulties or unpaid debts. These factors are not equally weighted. Their impact on your score may vary based on individual credit profiles. Maintaining a positive payment history, using credit responsibly, and avoiding excessive debt are key strategies to help maintain a healthy credit score. So what can you do if you want to improve your credit score? There are several effective strategies that can help boost your number over time. The first step is checking your credit reports from each of the three major credit bureaus: Equifax, Experian, and TransUnion. You're entitled to a free copy of your report from each bureau once per year at annualcreditreport.com. Carefully reviewing your reports allows you to check for any errors or signs of identity theft. Dispute any inaccuracies right away to keep your record clean. Next, focus on paying all your bills on time every month. Payment history makes up 35% of most credit scores. Even if you can only make minimum payments, do so before or on the due date. Set up automatic payments or calendar reminders if needed. Paying late can seriously damage your score. Another effective strategy is keeping credit card balances low relative to your credit limits. The credit utilization ratio, the percentage of your available credit you're using, makes up 30% of scores. Try to use no more than 30% of your limits, and even lower is better. Pay down balances before statement closing dates. You should also aim to open new credit accounts judiciously over time. The credit mix component of scores looks at the types of accounts you have, such as credit cards, loans, and mortgages. Having a variety can suggest you manage credit responsibly. However, too many applications for new credit in a short period can temporarily lower your score. It's also a good idea to become an authorized user on the account of someone with excellent credit history. Their on-time payments and credit limits will blend with your history and boost your score. Just make sure you trust the primary account holder to manage credit wisely. Finally, consider disputing any negative items you believe to be incorrect. Collections, late payments, and bankruptcies can severely damage your score for years. If errors are corrected, your score may rise. Dispute inaccurately reported items in writing via certified mail. With consistent effort over 6-12 months taking these steps, most people can improve their credit scores by 50,100 points. Lenders consider scores above 740 to be in the excellent range, qualifying for the best rates. Improving your credit score isn't an overnight process, but it's a journey worth embarking on. Improving your credit score isn't an overnight process, but it's a journey worth embarking on. Join us as we uncover the strategies and tactics to help you boost your creditworthiness and achieve financial success. There you have it, a glimpse into the importance of understanding how to improve your credit score and steps to initiate your journey. If you found this video insightful, don't forget to like, share, and subscribe. Stay tuned for more financial wisdom right here on Money Matters, Mastering Finance and Investment. Until next time, stay financially savvy.